Might be out of paper. All right, ladies and gentlemen, 14.3. Now, 14.3 literally is 4 points. This is not long. That's why I'm doing 3 of them, okay? You're not aligned. Okay, so on Friday, we went through and we did our trial balance on our worksheet. Purpose of a trial balance, make sure debits and credits are equal. The other thing that we did within our trial balance is we went through and we did our adjustments that we had known before. We did supplies and we did prepaid insurance. Now, we have 2 different supplies accounts. We have supplies office and we have supplies store. Okay, just to clarify the difference between supplies office and supplies store. Supplies office, those are the things that have to be in the office area in order for the business to run and operate. Supplies store is going to be where the customers come in and buy stuff. So they go through and keep track of things separately because it allows them to go through and make decisions better on where they need to go through and watch their expenses. So we went through and adjust both of those. Now, I need you to remember, this is the part that kicks everyone in this chapter. The adjustment column is what we have used up, okay? Not how much we have. When we read the directions, it says the value of prepaid insurance. After the physical count, the value of supplies is. Do not use that number and put it in the adjustment column. Now, we need to talk about merchandise inventory. Merchandise inventory is the account that we use when we go through and buy stuff that we're going to turn around and sell. Okay, so I have my golf business. I'm going to buy golf clubs. Those golf clubs I'm going to buy and then I'm going to turn around and sell to my customers. Okay, it cost me money to buy them. When I bought those golf clubs, I went through and credited cash and debited Nope. When I buy merchandise on an account, if I pay cash for merchandise, I credit cash and I debit purchases. Purchases is a cost account. Okay, that is important for you to realize because throughout the year, at the beginning of my fiscal period, the account purchases is at 0. As I buy stuff throughout the year, the balance of purchases grows, and it grows, and it grows, and it grows, and it grows. Now, we have 2 contra account to purchases. We have purchases, returns, and allowance, and purchases, discount. Purchases, returns, and allowance accounts for the fact that we return stuff. Purchases, discount is the fact that sometimes we get things on sale or a discount. So, purchases is a cost account. Starts with a 0 balance. We buy stuff, gets bigger. Now, merchandise inventory, we have not done anything with that account all fiscal period, okay? The value of merchandise inventory, when I look at my worksheet, that $248,752.25, that was how much merchandise I had on January 1st of my fiscal year. Now, all of the items that I bought throughout the year go into purchases. At the end of the year, the business has to go through and do inventory. They count inventory to see what they physically have because there are things that happen in the world that do not follow all the accounting rules. I don't know why. That would be much nicer if they did. So, for example, let's say I go shopping with my kids. Forrest is really happy. We're walking through Don's. We're going through Don's, and he sees pickles. And, man, that boy loves pickles. He walks up, he grabs that jar of pickles, and goes, "Mom, pickles!" and then slips, drops pickles on the floor. Okay? Does Don's make me buy them? They don't, because they realize it was an accident. So they will go through and they'll get it cleaned up. But what happens to the value of their inventory now? They probably didn't. They're not going to, the person that cleans it up isn't going to remember go through and reduce inventory by whatever. Okay, now here's another thing. Let's say that somebody went through and stole a banana or a candy bar or, I don't know, bag of chips. Those are hard to stuff in your coat. It's easier in the winter. Okay? So would you agree there's theft? Okay? That is going to happen in life. So we have to go through and we have to count inventory to make sure what we have adds up to it. The school store also has to go through and do inventory. We do inventory twice. We do it at the middle of the year and the end just to make sure we know where things are at. Okay? So, the beginning of the fiscal period, we have our inventory account. We go through and buy stuff, it goes into my purchases account. At the end of the fiscal period, we do an inventory account again, and then it goes through and gives us our current value of our merchandise. Now, is it possible that the value of our merchandise is higher than what it was on January 1st? Yes. Could it be lower? Yes, it could be either way, because we could have bought more this year, or we could have not sold as much. Either way, that's going to be what's going to happen. So I can't tell you, like supplies and like prepaid insurance, that you're always going to debit or credit merchandise inventory. You have to look to see what the value is, how it adjusts. And when we take a look at Work Together 14.3, it says from a physical count of merchandise inventory, the December 31st balance is determined to be $234,904.20. Higher or lower? It is lower. We're going from 248 to 234, so it's lower. Are we debiting or crediting? We have to credit it. How much? How did you find that number? Subtract the 2. Take the 1 from my trial balance and subtract the information they gave us in my adjustment column. Now, here's the thing. This is pretty point obvious in Work Together. What account is also affected? Income summary, because it's the only other one you can enter a number in. So, way to go, Captain Obvious. Aptly, you gave me the answer. But you are going to find on your test, they are all going to be available, and you got to remember which one it goes to. So please remember, when you adjust merchandise inventory, the other account that you're affecting is going to be income summary. Okay? Try that. I know I didn't put the number on there, but that is how you do 14.3. Do you see why I can crank through a couple of these today? A lot of work for someone that doesn't want to do any work, right? So it's $13,848.05. Are we agreeing with that? No one's agreeing with me? Oh, thank you. Did you do the on your own? That was a very aggressive yes. He's like, come on, Grasso. Credit, merchandise inventory, debit, income summary. Because it needs to go down. All right, 14.4. 14.3, 4, and 5 are all new adjustments for us. 14.4 deals with the fact that we have customers that have bought on account from us, right? But sometimes those customers don't pay us back. Okay, so we have an account called Allowance for Uncollectible Accounts. You will notice that that account shows up immediately after accounts receivable. It is a contra account to the accounts receivable. Contra accounts mean they're around just to keep track of things that take away from it, like Mrs. Grassel Capital and Mrs. Grassel Drawing. Okay, purchases discount, and purchases returns and allowance. Those are all contra accounts. So we have allowance for uncollectible accounts. And then what happens is an accounting or finance person has to go through, after a certain amount of time, they write off people that do not pay. Okay, so here's my example. So I am a gas station, and I have customers that come in and they charge on account. So let's say I have a business like a trucking company. They're not going to go through and give credit cards to all of these different people. They're just going to say, stop and fill up at this gas station, and then I will go through and send them a bill at the end of the month. That is very common. That does happen. So all of a sudden my trucking company goes out of business, and I owed the gas company $3,000. Okay? Now, they're going to keep sending me a bill, and they could go to collections. What does collections mean? They kill me? No. So if they send it to collections, basically, if I own a gas company, is my expertise in trying to get people to pay? Where's my expertise? The gas company and all of the things that provided with that. So eventually, if I send out bills and they don't collect, I would then go to a collection company. Their main job is to what? Get the people to pay. So what happens if I pass it over to collections is oftentimes the collection company will take part of a fee. So instead of getting $7,000, let's say that I get $6,750. So they keep $250 for their job of trying to get the money. Okay, so we pass it over to collections. The collection company is going to be the one that's going to go through and try to make me pay. But eventually they say, Mrs. Grasso, you're out of luck. They are not going to pay. So then I would write them off. Now, if I write off an account, I don't want to, 3 years from now, if they open back up again, I don't want them to allow to be charging again. Would you agree? So we have to do some specific things in their ledger account to make sure they're written off so we can see that they never paid on the bill. But we don't want to have that $7,000 sitting in accounts receivable for a long time. So allowance for uncollectible accounts, a business will go through and they'll take a look at all of the accounts that were charged throughout a fiscal year. Now, that can't be sales. Because when I use the account sales, that could be if you paid cash or if you charged an account. So they actually have to go through and keep track separate of their total amount of sales on an account, and then it's going to be a percentage of it. So when we see here, Coastal Aquatics estimates the uncollectible accounts expense as 0.5%. Is that very high? No. But they realize not everyone's going to pay. So it's going to be 0.5% of its total sales on account. And it says, during the current year, Coastal Aquatics had sales on account of $424,000. Record the uncollectible account expense adjustment on the worksheet. So what they want us to do, you can see previously, allowance for uncollectible accounts had $524.84. Do you see on our trial balance? It's listed as a credit because it's a contra account to the accounts receivable. We have to go through and take 0.5% of that $424,000. Did anyone crank out that number for me? 240? Say it again. 0.5% of the 424. The multiplication is what I'm looking for. $2,120? Okay. So, this is what the business is saying. This is going to blow your mind. Ready? My adjustment is that $2,120. You're actually using that number. Okay? You're not going to subtract or add to get that number. What they said is at the end of this year, we still have $524.84 as accounts that we think will be allowance for uncollectible accounts, and we're going to add to it $2,120. So that needs to increase the account by that multiplication number. So if I credit $2,120 to allowance for uncollectible accounts, guess what gets debited? Uncollectible accounts expense, $2,120. So for 14.3, nope, 14.4? 14.4, you multiply and take that number, and that's the amount that goes in the adjustment column. This one will take me a smidge longer to explain. 3 and 4 have not been too hard. That's why I said I'm going to do 3 today. Okay, now 4. 5, we're dealing with depreciation. Depreciation is what happens when you use stuff. Okay? You buy a vehicle, brand new, nice and fancy, drive it. The more you drive it, the less it's worth, right? What's something else that would depreciate? Say it again? An RV, yes. A house. Houses actually don't depreciate. They should appreciate, go up in value as long as you maintain it. If you don't maintain it, it would go down in value. So a house is going to be reversed, where it should go up in value. Phones, computers, Jinx, oh, got it. Printers, any electronics? Okay, here's something else I want you to think about. I am a business. I bought a cash register. If I bought the cash register brand new today, 5 years from now, is it going to be worth the same amount? No. Okay. Okay, how about chairs? Right, they get depreciated. Agreed? Okay. So any asset that you buy and own, besides houses and buildings, those tend to go up, are going to be depreciated. Okay? In order to calculate and find depreciation, you have to know a couple things. The first thing that you have to know is how much did you pay for it? And that should be easy to know, because what you end up doing for someone that goes through and calculates your depreciation, you would actually have what you originally paid for it, and then you have what is called its useful life. And you always want your useful life of your phone to be shorter so you can get a newer one faster, don't you? Okay? But typically they'll go through and say, all right, here we go. Now, right now, the high school is in a little bit of a pickle. No. The pickle is we have some Chromebooks that are at the end of their useful life. End of life, okay? And they tend to be this model of Chromebooks are the old ones. So when we bought Chromebooks, Google will go through and say that you can probably use these for 3 to 4 years, and then after that, you shouldn't use them anymore, and we're actually not going to update them anymore. Reason being, they need to have more space, more memory, that type of thing, so they go through and do that. But the price point on these computers are relatively low, right? So we're at a little bit of a pickle because we have how many carts of these types of Chromebooks? I think we have 2 or 3 carts of those types. And we have other people have towers with newer ones, and those are not at the end of the useful life. So we need to know, like, when you buy them, what they do. Now, when you see electronics at the school, there are asset tags on all of them, okay? Even on my computers here in the room, on the very top of the tower is an asset tag. That asset tag is tied to a list of all assets and their depreciation and their useful life. So they know that this asset tag number was bought on this date for this value. Now, my computers in here are getting towards the end of their useful life as well. These computers are much older than the Chromebooks, though, because they cost more and they're supposed to last a little bit longer. So you have to, as a business, go through, and you don't want to have 1 year where you have this large expense of electronics that you have to do. You want to try to do it in kind of stages or waves. Otherwise, you have one big expense. So as a business, we have to know how much we paid for it, how long are we supposed to use it, and then there's also something called a salvage value. The salvage value is how much is it worth at the end of its useful life, like what could we sell it for? So could I sell this chair for something? Okay, I could sell it for something, right? Now, there is a standard set out by the government to say this would be what its salvage value. So a business doesn't go through and say, I'm going to say this salvage value is $200, because no one's going to buy this for $200. Okay? Would you agree? So there is a standard there, and there's also called the useful life, like how many years it's supposed to be good for, is also going to be set to say this is what you would depreciate it by. So a business doesn't have to go through and decide it. It's already a table out there that they would look at. So we have to go through and calculate how much each asset we own depreciates each year. Every asset a business owns has to be depreciated annually. That's a lot of work. So what they end up doing is at the end of the fiscal year, they go through and depreciate all of these assets. They also have assets they've sold off, they no longer have, and they have a total amount of depreciation that their assets have. And businesses like depreciation. And here's the reason why. Depreciation is an expense. What do expenses do to your net income? Make it go down. The less money they make, the less taxes they pay. Did they really have to pay anything out for depreciation? No, it just decreases. The value of your assets go down and the amount of your income goes down. So businesses will be very strategic about their expenses. So, for example, my sister, who owns a lawn care business, this past year they bought a snowmobile dolly. Okay? Now, they also own a small hobby farm. They then use that snowmobile dolly to move the chicken coop to different locations in the field. So now that item is now part of the farm, and they can depreciate it and decrease their in net income by their expenses. Small business owners need to be very smart about what you buy and being able to write it off for expenses, because it then lowers your taxable earnings. Okay? Granted, yes, they paid it out, but they can depreciate it. Now, a snowmobile dolly, do you think you can depreciate that 10 years? No, it's going to be a smaller asset that would be around. Now, what do you think would be an asset that you'd be able to depreciate more than 3 years if I owned a lawn care business? Lawnmower? Trailers? A truck to drive them around? You agreed on those type of items? So you're going to have a mix of like short-term and long-term assets that you're going to own to go through. So the first thing that we have to do, and this is just a real small thing that we're learning about in Chapter 14, is to calculate how much an asset would depreciate in a year. Now, on the test, I will tell you, they will give you your total depreciation for all of your assets, and then you will just be plugging in. But we have to go through and calculate and just learn how to calculate depreciation. Now, we have two different types of assets that we're going to be depreciating. We're going to go through for office equipment and store equipment. Okay, so that's why one of the things we'll do. So down here, they kind of have the formula to see for how much we're going to be depreciating. So let's go through and do number one. Calculate depreciation expense for a computer printer costing $1,600, estimated salvage value of $100, a useful life of 5 years. So original cost, $1,600. Estimated salvage value is $100. So how much total can that printer depreciate? $1,500. We're just doing straight up math. $1,500. Now, how many years can we depreciate it? 5. So I'm going to take 1,500 and divide by 5. So my depreciation each year is 300. Now, you do that for every asset. Okay? You go through and say, how much is it depreciating this year? And it's really easy if you buy it on January 1st. But what happens if you buy it in the middle of the year? Do you depreciate it for a whole year? No, you would have to do something called partial years depreciation. We're not going to get into that in Accounting 1, but in Accounting 2, we learn about partial year depreciation. It's fun. So number 2, we have to calculate the book value of our computer printer at the end of the second year of service. So we have to put in our original cost of $1,600. How much is it depreciating year 1? 300. How much are you depreciating year 2? 300. It's called straight line depreciation, meaning every year we own it, it depreciates the same amount. Now, a car is not straight line depreciation. It is not. A truck, a vehicle, those depreciate based on what? Mileage. So that kind of depreciation is calculated slightly differently. Straight line depreciation is the easiest, so that's what we're learning first. Okay, so what is our total depreciation so far on our printer? 600, right? So we take 300 year 1, 300 year 2, 600. So we originally paid $1,600. We have depreciated at 600. Our book value is now 1,000. Book value would be, if we wanted to sell it, that would be the current value of it. Okay? Now, that is only one portion of 14.5. The other thing we have to do is go through and record our depreciation. So to do our depreciation, now we're looking on the number 3. It said Coastal Aquatics determined the total depreciation expense office equipment of $6,120. Now, here's what's going to happen. Every year, our total accumulated depreciation is going to grow, and it's going to grow and grow until we no longer have that asset, and then we take it off the books. So, just like 14.4, the amount that they give us goes straight up on the adjustment column. So I'm going to go ahead for office equipment, and I'm going to do a credit of $6,120 for accumulated depreciation office equipment. And then my debit is going to go down to depreciation expense office equipment of $6,120. I'm going to repeat on store equipment, $5,060. Now, somebody's gone through and got this $5,060 number for us, but a business needs to get it calculated. And then I'm going to debit depreciation expense, $5,060. So that should be what your expenses look like. You have 2 credits for accumulated depreciation and 2 debits for depreciation expense.